Hello and welcome back to the channel. Today we're going to be talking about exchange traded funds, or ETFs for short. We're going to discuss what they are and how you trade them, and also compare them to mutual funds. ETFs are a great introduction to the stock market and a very simple way to get started with stocks. Before we can really understand what an ETF is, it's a good idea to understand what a mutual fund is, because the two are often compared and confused. If we have a look at the definition on Investopedia, a mutual fund is a type of financial vehicle made up of a pool of money collected from many investors to invest in securities like stocks, bonds, and money market instruments. Mutual funds are operated by professional money managers who allocate the fund's assets. In general, the fund will follow a theme or an investment goal as well, like technology growth stocks or consumer staples or something like that. The shares in the fund are then split between all the people who invested in the fund, but based on the amount that you put in, obviously. So a simple example might be, let's say you and some friends decide to pool your money together and want to buy some stocks. Well, you and your mates don't really know anything about investing, so you hand your money over to an asset manager who knows about the market and investing in general. So they then manage your money for you in the market and buy and sell shares to try and make you a return on your investment. Mutual funds have some significant cons when compared to an ETF. So firstly, you have to pay the asset manager for the privilege of managing your money. You have to pay them management and admin fees, advisory fees, all of that. And overall, this just eats into your returns. Very few mutual funds actually beat the market overall. We're talking like only the top 2 or 3% actually outperform the market. The rest either lose money or just don't beat the market. You still have to pay fees even if you are losing money. So that's a really important point. Even if your return on your investment was 0% or negative, you still pay the asset manager. Okay. And lastly, they are actively managed, meaning that a person is buying and selling on your behalf. Most of the time, this just costs even more money in taxes and brokerage commissions, etc., as you move in and out of the positions. So overall, that's mutual funds. It's important to understand those before we can understand an ETF. So let's talk about what an exchange traded fund is now. As we did before, I'll read out the definition from Investopedia. So an exchange traded fund, or ETF, is a type of security that involves a collection of securities, such as stocks or bonds, that often tracks an underlying index. ETFs are in many ways similar to mutual funds. However, they are listed on exchanges, and ETF shares trade throughout the day, just like an ordinary stock. Okay, so there are some important key differences here. Technically, ETFs are still a big pool of investors' money, and you're buying a group of stocks in the market. However, they are set up to simply track an index. So for example, the ASX 200, which is the top 200 Aussie companies, or the S&P 500, which is the top 500 American companies. When you buy the ETF, you are essentially buying a little piece of those 200 companies or those 500 companies. So you're just participating in the market overall and getting whatever gains that the market has to offer in that time. On the screen, you can see the S&P 500 index, and this is going all the way back to 1981. So overall, you can see that the index slowly rises over time. And the two big dips you can see are the dot-com bubble in the year 2000 and the global financial crisis in 2008. However, even with those two massive crashes factored in, the S&P 500 has still returned an impressive 9 to 10% annual return. And if you have money compounding at that sort of rate of return over the long run, it'll actually turn into a small fortune. Just as an example, if you had invested $500 a month into the S&P 500 over the last 10 years, that would have turned into $120,000 by now. So remember, the return of the market overall is what the asset manager from the mutual fund is trying to outperform, but rarely does. and whilst trying to outperform it, they're also charging you fees along the way, which has a big impact on your overall return. Okay, so let's summarize by looking at some of the pros of an ETF overall. So the fee is extremely low, and we're talking like 0.25% for some of them, which is almost nothing. This is because they are passively managed and pretty much mostly done by computers these days. So there are very few fees involved or costs involved for the companies that offer these ETFs. You can buy and sell them like stocks on a stock exchange. This is great because you can buy into them whenever they dip and you can get the exact price that you want. This also gives them a lot of liquidity, which means you can sell them whenever you need the money. Next point, they match the index that they are tracking almost exactly, and they get the return of that index. So when you buy a share of an ETF that tracks the S&P 500, you're getting a very small piece of the top 500 companies in America. The thing to remember is though that the ETF is not trying to beat the index, it is trying to match it exactly. So you get whatever the return of the index was overall. And lastly, they're a great way to diversify across many stocks when you don't have a lot of money to spend. So imagine the cost of buying a little piece of 500 of all those companies in the S&P 500. You'd need a small fortune to do that. But with an ETF, you can buy a piece of the ETF for just say $500, and you get a little chunk of each of those companies. How do we actually trade ETFs? How do we buy them? So you need to look up the stock market symbol for the ETF that you're interested in. Then through your brokerage, you can buy a certain amount of the ETF. So on the screen are some ETFs that you'll find on the Australian Stock Exchange and what they relate to. So IVV is the S&P 500, IOZ is the ASX 200, IOO is the Global 100, and VAS is the ASX 300. So those are just a couple of examples of different ETFs, but there are loads of different ones out there. In a future video, we're going to look at some of the best ETFs on offer here in Australia and dive a bit deeper into what they hold and their returns and things like that. There's a lot of different themes to ETFs, so you don't just have to track a simple market index. There are ones out there for things like the health sector or technology stocks, for example. So keep an eye out for that video coming up, and thanks for watching. So please remember to like, share and subscribe if you enjoyed the video.